So, looking at the chart, we can't really do too much of a review because, as you guys know, since Tuesday, since that pre recorded lecture came out, I pretty much told you guys it was likely we were going to do this and just be very, difficult to navigate, choppy market, no real precision elements being presented. So, there's nothing really to review on the lower time frame. And right now, we are just waiting for non-farm payroll, which is tomorrow, to clear things up. So also in that pre-recorded lecture, we had buy-side liquidity up here and sell-side liquidity down here, which I said would be 50-50 to which side price would draw towards. As you guys can see, price has attacked sell-side liquidity so far. So trying to gauge this market is very, very difficult. And what we have to do is pretty much just only rely on time because there's no real, high probability sequential SMT down here. There's nothing really tipping its hand telling us for either direction. But we do have time. So whenever we're trading away or a distance from that weekly opening price before non-farm payroll, more times than not, what do we expect? This is the interactive part. Return back within the range. Yes. So this is the only thing really tipping its hand right now is just using time. Does that mean trade ahead of non-farm payroll and long right now? No, because it very well could continue going lower. But using the tools that we have, using probabilities, we know that more times than not, Friday will return into the weekly range. So for an idea to gauge non-farm payroll, since we've ran out these lows right here, which we had marked out on Tuesday, we've ran those stops, we're trading away from the weekly opening. What has my eye are these equal highs right here. And to further support that idea, is as you guys know, also in that pre-recorded lecture, I said whenever you have the dollar trading in the exact same direction, and we can pull out the dollar real quick. So here on the left, we have the S&P. In the middle, we have the euro. And on the right, we have the dollar. So gauging and using intermarket analysis, as you guys know what I say you don't really need intermarket analysis if there's something between the immediate triad you're trading. That does hold substance, but whenever it comes to navigating through low probability conditions and especially identifying low probability conditions, it's always best to, keep in mind or check every now and then what the higher time frame order flow is between the currencies being the euro, the Great British Pound, and the dollar, as well as the futures triad. So it's best to look at those triads in the higher time frame order flow just to get a gauge on if the markets are in sync or not. Because whenever the markets are not in sync, things like this tend to occur, where, as you guys know, throughout this whole price action, it's been very difficult to find opportunity, and some of you might have even gotten frustrated just because, price has been really tight. But if you would have known to look, and I said this on Tuesday, if you look between the S&P and the dollar, it's trading in the same direction. So these are low probability conditions, and whenever that happens, you get price action like this. But something to add on to that, whenever you have the euro and the pound trading higher, while the S&P is trading lower, and there's a large news event that day, generally, whenever that news event releases, one of the triads one of the triads will expand to catch up with whichever one is the leader, and the other triad will just be, lackluster whenever that news event releases. So the best case scenario is the S&P and the futures triad catches up with what the euro and the forex triad has been doing as a whole, while the forex triad just kind of stays lackluster in the meantime. But we'll see, because it could be, like I said, either direction. But after non-farm payroll releases and that day closes, that's when things will clear up a lot more, because there are really no algorithmic signatures tipping its hand telling us price is likely to go one way or another. So that is the thought process of how I'm viewing the markets right now. No, dude. Even without an SMT on those lows, we're just relying on time. So it could be either way. Either the S&P or the futures triad as a whole will be consolidative, while the euro and the forex triad expands lower upon that non-farm payroll release. That's a possibility, or it's going to be the other way around. But generally, whenever there's a large news driver and two triads that are supposed to be closely correlated, whenever they're moving opposite, once that news release forms or opens up, that's whenever clarity gets brought. And we also have Powell tomorrow. So definitely do not day trade tomorrow. Next week should be a lot better. There have been times when DXY was trading in the same direction as the futures triad, and we were still accurate while talking about it now. Q1 of the monthly cycle. Yes, that also plays importance. When should you expect price to only draw into the wick of the reversion level and not the body? In other words, is there ever a reason to not set a limit order at the open but the wick instead? Should we expect at least one market to draw into the body? It all depends on how well you can correctly identify which asset is stronger for the direction you're trading. And that mainly comes by means of experience and actually being there, because there's so many factors that come into play. But after time, you'll get better and better at, identifying it. Today, price expanded upward into a 1 hour fair value gap before reversing attacking sell side. I was looking for a 90-minute cycle sequential SMT or a 15-minute, even 5-minute TPD to show sign reversing. A bearish microcycle instead presented itself in the 1 hour fair value gap. Is this a trade you would have taken? Am I wrong or right for not taking the trade? That is not something I would have taken. And personally, didn't even look for anything today. On non-farm payroll weeks, I personally wrap up my trading Wednesday, unless I see something before non-farm payroll releases, and I'm willing to not roll the dice in a sense, but see something where it allows my stop loss to be a lot bigger than usual, and trade news releases, because there is a way to know more times than not where news is going to go. But Do you think there's a good probability index futures won't go lower because there's no more if to draw on liquidity below where price currently is? Yes, that's a factor. Unless non-farm payroll just completely shits the bed, I'm not bearish down here. In the past, you used the CFD to show a cracking correlation. Take a look at the monthly time frame, November low on NQ versus US 100. In this case, NQ barely took the low. I recall you saying a small turtle soup would need to go back for more liquidity. Is that correct? Under certain circumstances, because whenever you compare the CFD and the futures data, that's a little bit different. So you wouldn't expect the Forex triad to draw back into the daily imbalance it created. And we also have a daily TBD with the Forex triad, but I'm not sure if it will be a continuation TBD or a retracement TBD. If anything, it'll be a retracement TBD. As you guys know, like I said, whenever you have the whenever you have the futures triad and the Forex triad trading in direct opposing directions, whenever there's a big news event or the next one of them is going to play catch up, meaning the S&P would expand higher, catching up to what the euro has done, while the other one that isn't playing catch up is going to be more so consolidative upon the news driver, allowing the markets to become synchronized again. That's the thought process. So we're literally just using time for the analysis. So if anything, it would be more of a retracement, but just more lackluster. If futures catches up to Forex tomorrow, will that be continuing into next week's CPI? That would be best case scenario. But it's all right now just an if then, because it could be either or. Is there an SMT with the Dow, but is out of sync for regard to premium discount, but the next candle moves within discount? Would this SMT be considered valid? Any SMT can be considered valid as long as it is confirmed. When do we not need SMT to trade? You guys will find out. And those that have been with me for a while, some of you might already know. I've hinted at it in the past, but yes, TPD does play into effect, but there is a sequence which I will bring later on to where you don't even need sequential SMT. Once you have the narrative, sequential SMT, you can completely just disregard it. All you're focusing is just gaps and the open, high, low, close. And yep, the continuation model. The continuation model goes a little bit deeper than what I brought. Same with reversion levels. Once I bring everything out, it's gonna be like gonna be as close as you can get to perfect mechanical trading. Because everything I teach is just if then. If price does this, then this will happen, and then if that happens, then this will happen, and then if that happens, that's all I teach. There's nothing ambiguous about it. We're trying to dive head first, not walk down the steps. And now we know a lower time frame entry is a reversion level. And along with that, and this is what you guys are going to get this weekend, so I can talk about it a little bit. But let's say that, and I'll put this out there because this is what we're talking about this weekend. But every diagram that I put out in those videos, all those little, let me draw it out. You guys know what I'm talking about, like the little lines to show the diagram to show price. Clip for me. All of those lines mean something. They're not random. Nobody has seemed to put it together yet. And then once new stuff gets brought out, especially this weekend, and then you go back and watch the first one, you'll be like, oh my goodness. It was there the entire time. You just hit it in plain sight. But anyways. Draw it out a little bit better. So let's say this is our reversion level. How do you know if TPDs are really high probability? What is the highest probability TPD? How do I know when they actually hold? How do I know? By viewing market structure before that reversion level forms. More times than not, the highest probability reversion levels will have a short period of consolidation beforehand. Price will run, trade, and then create a true turtle soup, and then create that reversion level. Price trades back into the reversion level, trades higher. Whenever I first introduced this in one of the live streams and the pre-recorded lectures, I said fair value gaps that intertwine, or not intertwine, fair value gaps that are a byproduct after a reversion level is tagged into and expands can be used. If you pair that with that short-term consolidation that forms before the reversion level forms, throw those together, like I said, entering is going to become the easy part. But we'll save that for this weekend. Do you have a checklist of conditions to make it black and white when you stay out of the market? Yes. What day of the week is it? Like, for example, Thursday, the day before non-farm payroll. Generally, do not look at the markets at all. Don't trade. Unless it was something, that was brought beforehand. But day trading wise, it all depends on day of the week. As well as the news drivers, and if the previous day was a large range day, if the weekly expansion or the weekly objective has already been met. Just those are the types of questions you want to ask yourself whenever you're deciding whether or not you want to look for something. The reversal in TPD sauce was for this quarter. Any sauce expected next quarter? Yes. The continuation model. overlap between original consolidation and fair value gap is precision entry after the reversion level? Yes. But that's not the original consolidation. The original consolidation, more times than not, is the breaker. Is that what you showed us, the universal model plus reversion level as a breaker? Not sure what you mean. But to ask what is going to be explained this quarter, next quarter, whatever, new things are probably going to come out until, I would say, it's already about to be, it's March right now. New things are probably going to be released every week, probably until May or June. And then after June, it's just going to be you guys being with me, and I just give my analysis, and we do reviews, and then forging the information. Can you guys hear me clearly? How will the new people in April catch up? I'll give them a week. So they'll have a week to where they're just by themselves watching core content, and then after that, then they'll get price reviews. But all the price reviews and all the live streams that you guys have access to in the content section of the WAP, like only you guys will have access to that ever. I think PD arrays play a big part in it for stop loss placement and so on, but how to know when the stronger asset in regards to TPD will still turtle soup candle 2. It depends on if there is a reversion level inside. Reversion levels tell you whenever TPDs are high probability. That's just clear cut. So if there's no reversion level inside of a TPD, then it's likely that all assets, or in your case, the stronger one will soup, even though it's technically quote unquote not supposed to. After June, it'll be just forging the concepts. So everything that I bring, and it might be a little bit later than June, because I don't know how long it's going to take for me to even bring all of this out. Because there's still so many things that I have yet to even speak about. But after that, once all the content is brought out for the year, that's the rest of the year will just be focused on forging the concepts, and it's just you have direct access to me, and you have my analysis, and you have my reviews. Is the audio cutting out? Okay. Do all assets need a reversion level to be high probability, or just one? Generally, all of them will have it. But the weaker one will be the one that creates the soup on candle 2. Did you just say the WAP content will be viewable after the year is complete? No. You guys will be the only one that has access to Q1 live streams and price reviews. So that crazy that crazy streak that we went on at the beginning of the year of like calling all the major moves, you guys will be the only ones that can see that or see the recordings Show us how to work within multiple ranges of time at the same time. Would you believe me if I said I already did? But yeah, with that being said, I think we're probably going to cut it here. So we'll have to this last one. The only thing we need is narrative. Once that is acquired, will be monsters. Yes. Once the narrative is established, and right here, like there is nothing tipping its hand for narrative, even at the height of the range, even at the low end of the range. There's nothing. So we're just relying on knowing it's Q1 and Friday non-farm payroll. If we're trading away from the weekly opening price tends to return back into that. That's the only catalyst that we have right now. So it's just waiting for narrative to be established.